So I'll ask my panelists to turn on their videos. Hello, Jared, were you with us? Yeah, there we are. Excellent. So very good morning, everyone, and thank you for turning out for this morning's 2021 AmCham Economic Outlook Forum. My name is Maxwell Okello. I'm the CEO of the American Chamber of Commerce, AmCham, and it is our hope that you, your families, and colleagues are doing well, and our very best wishes for a healthy and better, much better new year. I want to recognize the presence of our AmCham board members and our founding patron circle members present, GE, Coca-Cola, Cisco, Google, and Mars Wrigley. In terms of format, we will start off with a presentation from the World Bank, followed by a discussion between the two economists, whom I'll be introducing briefly, before we open it up to a moderated Q&A session with the members. I encourage everybody to please post your questions in the Q&A tab at the bottom of your Zoom window as the session progresses. Now, the events of 2020 truly tested our adaptability, pushing us all beyond any scenarios we may have imagined. We were forced to find new ways of living and of working, and for many, new ways to survive. Thankfully, Kenya has so far been spared the worst of the health crisis, but similar to other countries globally, we have not been spared the economic impact. It is in times like this that the power of true partnership and thoughtful collaborative action shines through. We are especially proud of the support to the pandemic response and the economic recovery efforts exhibited by AmCham members and the business community at large. We are also grateful to the thoughtful and decisive action taken by the government, quickly implementing measures to safeguard lives and support business continuity, including economic stimulus programs. Now, this level of partnership and collaboration that prioritizes the country's best interests and our collective future will even be more critical in the days ahead as we move forward on the path to recovery. As a chamber, we are cautiously optimistic that we've entered the recovery phase. We have received reports from our members in the agriculture, manufacturing, FMCG sectors who are slowly seeing an uptick in business, and this gives us hope that this will be mirrored in other sectors as well going forward. According to feedback from a recent member poll, growth is a priority for members this year, even though the view on economic performance remains conservative. As such, most of our members are placing an emphasis on support for opportunity development. Expert briefings and thought leadership, such as today's forum, are valuable as they bring insight and give perspective. The COVID-19 pandemic remains a major threat for business. However, the heating up political scene, as well as the never-ending tax and regulatory changes, remain key concerns for our members. At this fragile time, any additional threats to stability and business continuity, if not managed, may complicate economic recovery. We are therefore deeply concerned with measures that further stretch the resilience of business. To avoid holding back the country's economic recovery, it is important that the right policies are prioritized. Taxation measures, for example, need to align with efforts to boost economic activity and lower the cost of doing business. And this alignment can only happen within the framework of a collaborative process of introducing new taxes, fees, charges, both at a national and a county level. Now is the time to prioritize support for business and to put people, all the reported 4.6 million plus unemployed Kenyans, at the heart and the center of policy decisions that will drive job creation and, of course, business growth. So this morning, we want to unpack and take a deep dive into the World Bank's unique perspective on the economic impacts, performance, and imperatives for Kenya's much needed economic recovery, given the COVID-19 reality. As many of you may be aware, according to the World Bank, Kenya's economic recovery is projected to grow at 6.9, Kenya's economy is projected to grow at 6.9% in 2021, which is probably the highest projection that we've seen in Africa. Now, this optimistic view is backed by the country's strong macro fundamentals that the bank is tracking, some of which are captured in the recently released World Bank Kenya Economic Update. Our discussion this morning will focus on primarily three broad areas. The first one being Kenya's 2021 microeconomic outlook, and this will also include some high-level view or overview of East Africa. And then secondly, the economic drivers. What will actually drive these performance that the World Bank is projecting? And what are some of the risks and scenarios, including alternative paths that can get us to that level of growth? And then thirdly, the policy priorities, reform considerations, and gaps and realities that we have to deal with as a country. We will also get an overview of some of the micro level economic data and perspectives from both the World Bank and from our economist, Jared Osoro. And we have a really great panel of experts to take us through this important discussion this morning. We are pleased to have with us Alex Senat. Alex, you could wave to the audience. Alex is a senior economist at the World Bank, responsible for Kenya. And we also have Jared Osoro, an economist and director at the Financial Sector Deepening Africa, FSD Africa. Jared, just quickly wave to the audience. Now, before I formally introduce the both of them, we're just talking a little about their bios. I just want to remind everybody once more that please do post your questions in the Q&A tab at the bottom of your Zoom window, and we will answer these when we get to Q&A. So starting off with Alex. Alex Senat is the senior economist responsible for Kenya in the World Bank's microeconomics, trade, and investment practice. He has been based in Nairobi since February of last year. Prior to this, his 9 years at the World Bank have been spent in Indonesia and Mauritius, and also Washington, DC, specifically in the Treasury and Credit Risk departments. Early in his career, Alex worked as an emerging markets economist and fixed income strategist for Standard Chartered Bank in London, Singapore, Dubai, and also for JP Morgan in London. Our second speaker and panelist is Jared Osoro. Jared Osoro has over 2 decades of experience as a practicing economist in the financial sector. Prior to joining FSD Africa, he for 8 years had the dual responsibility of being the Director of Research and Policy at the Kenya Bankers Association, KBA, and the Director of KBA Center for Research on Financial Markets and Policy. He previously worked at the East African Development Bank, where he served as a bank economist for more than 10 years. Gentlemen, thank you very much for joining us this morning. And without much further ado, I want to turn it over to Alex to get this show on the road. Thank you. Alex, the floor is yours.
Thank you very much, Maxwell. Good morning to fellow panelist Jared and distinguished guests who've made the time to join us for the session this morning. We really appreciate on the World Bank side the opportunity to present and share our views on what we're seeing in the economy, and then certainly also hear the perspective of commercial players, which for us is extremely valuable to hear questions and perspectives and understand what you may be seeing. Let me share my screen. Just let me know if that does not come through. But we do have some slides that I'll go through with a very simple structure. We have to look back. I know looking back on 2020 may not have much immediate appeal, but we have to do it so that we can understand what's been happening recently, and of course then what does that mean for what I'll turn to in the second section, looking ahead, the global context, the regional, but then of course the focus on ourselves here in Kenya and the economic outlook there. And then just some thoughts regarding, what this means for policies and priorities when it comes to potential responses and ongoing reforms, which ourselves at the bank are obviously very focused on. So, taking stock of where we find ourselves, maybe the most intuitive data in some ways is mobility data. We've probably, many of us, become much more used to looking at this thanks to the increased availability of high frequency mobility data from sources like Google, which is what I'm showing here. And it just gives us a really nice overall sense of looking back at 2020. If we think back to the beginning of the strict containment measures in March, and then moving through to April, and the worst of the impacts of the crisis, April, May, maybe June, we can see, and it's intuitive in the mobility data, the big impact that this had on people's ordinary movements. One of the interesting ones is at the bottom left there, places of residence. So we had basically a 25% increase in normal levels, compared to normal levels of people basically being at home. And then we can see a similar pattern in all these different areas of a kind of trend normalization that seemed to take hold and get underway after about the halfway point in the year. And in most cases, we're not quite back to 100% normal, but we've certainly headed that way. Some of these dips at the end in these charts are associated with the fact that these data end in December, so they're also picking up year-end holiday and Christmas activity. If you look, for example, at the dip in the end of people being in their workplaces, that's normal. But the point is, we had this huge shock, and then we do see evidence of a kind of trend normalization subsequently. And this pattern repeats itself across a lot of the data that we look at. So many participants may be familiar with the Purchasing Managers Index. This is an interesting sort of summary view of business conditions. It's then summarized into this diffusion index, where anything over 50 means a sequential improvement compared to last month, and anything below 50 is a reduction in activity and in orders and the outlook compared to last month. And again, this big shock that took place basically, March and Q2 of last year, and then quite a significant subsequent rebound. And what this is showing is that sequentially, in every month since July, there's been a continued improvement in activity as picked up by this indicator compared to the month before. We look a lot at the labor market, as you can imagine, because of its importance for incomes and livelihoods, clearly. And here again, we saw really dramatic moves, and they remain relevant, as we think about where Kenya stands today. They're a bit lagged, but still. So pre-COVID, we're moving along at what in international terms is a very low formal unemployment rate of 5.2%. That doubles in the second quarter to 10.4%. And similarly, the blue line at the bottom, or turquoise, whatever it is showing a really sharp reduction in the proportion of working age Kenyans who are defined as employed. So it's the same story. This is a massive labor market shock. It's very unusual to see a doubling in something like the unemployment rate in just one quarter. So there's really no question that this was, a shock of really profound magnitude. The latest data we have, it's still quite lagged, unfortunately, but it takes us back to Q3, and we see a substantial, what I've called a healing in the markets, unemployment falling back down to 7.2% official rate. That's obviously not right back down to its pre-COVID rates, but it's moving in the right direction, about halfway back to where it should be. Hopefully, of course, that trend has continued. We fairly soon after the crisis got underway began what we call a rapid response household survey, which is basically leveraging off the survey infrastructure that we have to to do phone-based surveys of a smaller sample, but still representative, to understand, every couple of weeks, what can we find out from households about what they're experiencing. And we've continued to run this survey, and here we show the results up until November. We'll shortly have more. But this is attempting to summarize what kind of, in view of this massive shock, what kind of coping mechanisms have households resorted to. And unfortunately, one of the key ones, for example, is reduction in food consumption, with over 50% of surveyed households at sort of the peak period in the crisis, middle of last year, reporting that they were resorting to reduced food consumption. And that is obviously awful in terms of welfare, but also, potentially really long-term negative impacts, especially if that affects children, for example. But also reduced non-food consumption, relatively little access to credit. If we take a look at these, in fact, very little access to credit, if we take a look at those indicators at the bottom, households being forced to sell assets, a minority, but still that can have obviously very negative implications. One other thing to really highlight is look at the reliance on savings. So at the top bar is when we first did the survey, and we had close to 40% of households saying, yep, we've got savings and we're drawing down on them. By the time we get to July, September, that's down to 20%. And that's consistent with basically a drawdown in household savings. It's potentially also consistent with an improvement in conditions such that savings are no longer being required. But I think at least up until this point last year, we can condition on conditions still being difficult. So really, as you'd expect, but here we see it in the survey evidence, households are depleting the kind of buffers that they have to keep going. And then in the indicator below, you can see a doubling in the proportion of households that are resorting to some kind of different income generating activity. Trying a variety of different things to basically try and continue to make ends meet. So the micro data, and we have a lot of it, but I thought this was an interesting dimension just to share with you. The micro data and the macro data are pretty consistent in terms of the magnitude of the shock and the level of disruption that we experienced last year. Really painful shock. But Maxwell had talked about the cautious optimism on the part of the chamber, and beyond just our headline growth number. I think that is a view that we share moving forward, and that's based on our sense that actually, if we look back on last year, we also see some important signs of real resilience in this economy. And just some examples of this, we can track the value of mobile money payments. This is just the year-on-year change in the value of mobile money. So back when the crisis hits, we see a dip as the economy and business activity and transactions take a hit. Then we see the sustained upturn where, in fact, we end the year, more or less, up almost half compared to the year before. Now, this will be a mix of substitution away from cash, which, of course, the central bank and government have encouraged as a COVID containment measure. But I think it also speaks to, the level of ongoing transactions and dynamism and an economy that is far from shut down, right? There's a lot of activity happening, including as we see on the digital money platforms. Other indications of resilience, a lot of concern about what the export impact was going to be. So this chart on the left takes a look at the year-on-year percentage change in the dollar value of exports. It's quite volatile data, but it's interesting. Pre-crisis, basically in February, we see this big increase in exports. The thinking is that has to do with traders basically anticipating COVID disruption to come and front loading and trying to get ahead of that, especially when it comes to regional trade into the neighboring economies. So we see this big spike. Then there's exports do come under significant pressure, but subsequently again a rebound. I realize it's quite a messy picture. So the chart on the right just takes a look at the annual total of exports and compares the year on year. This is only January to November for each year because we don't yet have December. But it's pretty interesting. We end up with exports up by 1.8% in 2020 compared to 2019 in dollar terms. And I would describe that actually as quite a remarkable performance if we consider, global economic conditions and obviously the disruption caused by the pandemic. There's a lot going on behind this picture. Some categories really doing quite well, horticulture, tea, others obviously experiencing an extremely turbulent year, flowers and various other products. Another indicator of resilience that we think is worth highlighting, the bank was very concerned that globally remittances would take a huge hit, with talk of up to a 20% reduction in international remittances, which have become a really important source of foreign exchange into the economy and for particular households' source of income. The picture for Kenya defies those concerns, where yes, again, in the early months of the crisis, remittances did seem to be conforming to that concerning possibility. At one point they were dipping to be about 15% below where they had been the year before. But subsequently, again, sustained increases. And if we look again at the chart on the right-hand side, which shows the annual totals, we ended the year with remittances in dollar terms up 10.6%. We can break it down by source of origin, and we can see that, yes, remittances from Europe under pressure, but America more than made up for that. So this would be the diaspora, either based on continuing to have, reasonable income over where they are, or, drawing down on their own savings, but really supporting the Kenyan economy and relatives or networks back home. And if we look at the sum of remittances now at, moving up past $3 billion a year, these are a really significant source of balance of payment support now, and they were resilient to the crisis. So I don't want to spend much more time in the rearview mirror, but there's one more important thing to share because it sets us up for our forward-looking story. The major hard data that we look at is the national accounts, and we now have the national accounts data up until third quarter of last year. And this breaks it down into how much of a contribution was made by the main sectors of the economy: primary, basically agriculture; secondary, which is manufacturing and construction; and tertiary, which is services; and then taxes. And you can see we were chugging along quite nicely at 5.5% pre-COVID. Then in Q2 we get the main impact of COVID, and we go down minus 5.5% year on year. That's a huge shock. And then in Q3, significant rebound. But if we compare it to Q3 in 2020, we're still down by 1.1%. What drives that big shock? Well, you can basically say, thank goodness for agriculture, which is the primary, the turquoise bars. Agriculture had a good year in 2020, and you can see it continued to make a positive contribution to growth, and that really contributed towards things basically staying positive. Secondary did come under pressure, but it didn't result in a big contraction year on year. The really big one comes from services. So what was going on there? And if we look in more detail in this next chart at services, it's maybe a bit of an unexpected story. So this shows many of the main categories. One of the prime suspects is obviously going to be accommodation and food. So basically associated with tourism, that's the turquoise. And you can see, yes, that did contribute significantly to the contraction the economy experienced, as we'd expect, a big slowdown and almost shutdown in activity in many ways. But the really big one was education. So education is estimated by KNBS to have contracted in terms of output by, I believe it was about 57% year on year in Q2, and still close to half in Q3. Now, education is not a huge part of the economy, but when the output of a sector is estimated to halve, that does have a big impact on overall GDP, and that's what's happened here. So if we consider the overall contraction that the Kenyan economy did experience in 2020, actually a really big part of that was KNBS's estimate of what the result of basically the shutdown in schools and universities was on educational output. they estimate that that output basically halved, and that was a big driver of the decreases in GDP. I'll come back to this in the outlook. So looking ahead, first the global view. So the bank's kind of summary of this, this chart on the left is showing you world GDP and then breaking it down into advanced and emerging markets and developing economies. And no surprises, a huge contraction in 2020 led by the advanced economies where you saw really unprecedented declines, but also a big contraction for emerging. And then we see, a significant rebound in 2020. Rebound's maybe not quite the right word, recovery, and then that tapers off a bit in 2022. But it's important to note, given the depth of this decline in 2020, you're looking at, very large output losses compared to where the economies were tracking before, and those output losses are not going to be made up for a long time, and they may well prove permanent. So this was an even bigger shock than the global financial crisis. But I think it's also important to point to, there's obviously many countries behind the summary chart on the left, and there's a notable performance that's really worth, that's different and that's worth highlighting. So I've just done that on this table on the right. Look at China in East Asia. So from 6.1% growth in 2019 to still maintaining positive growth in 2020, despite obviously being the point of origin of the pandemic in Wuhan, we think. 2% growth in 2020, and then very strong growth continuing, we project in 2021. So China is the major global economy that really sort of bucks the trend you're looking at on the left-hand side. And of course, for global commodity prices, for many of our economies in the region here in Africa, that's an important bright spot and a source of potential optimism that can be a source of growth moving forward. In our region, just a summary of what we see across the different countries. For the Kenyas, Rwandas, Tanzanias, it's a similar story where we were at quite a high run rate coming into the crisis. Crisis comes in 2020, and we go into generally small contractions. We expect that's the case for Kenya and Rwanda. Tanzania remains positive. And then, significant rebounds that we're looking for in 2021, or recovery stories with Kenya being the largest in terms of magnitude, but also strong recoveries elsewhere. Burundi and South Sudan, obviously kind of different drivers, fragile, conflict-affected countries, and so the dynamics are a bit different. And Uganda, obviously, with some of the politics and a less good recent growth performance. So that's at a very high level how we kind of see the region, and you can see that Kenya, the experience is broadly comparable to what we think is the case for a country like Rwanda, for example. If we zoom out even further and we think about our countries in the region compared to all of those in sub-Saharan Africa, you can see we've got some of the growth leaders expected. Sorry, that says 2020. That's an error. These are growth projections for 2021. So Kenya would be the highest in Africa, but Rwanda not too far behind. Tanzania, Uganda, kind of middle of the road, and then, as I mentioned, Burundi and South Sudan have sort of different issues. And you can see there's quite a wide variety of expected recovery stories across the continent. Of course, many different sorts of economies, resource dependent or otherwise. So let me give you a bit more detail on this Kenya view. Here we were in terms of our projections pre-COVID, where we were running at around 5.5%, and we essentially expected that to continue. And this was roughly the estimate of Kenya's kind of sustainable or potential growth rate. COVID comes, and as of the last Kenya economic update, which Maxwell mentioned, we're at -1% estimate for 2020. With this rebound to 6.9%. But I'm afraid there is a little bit of a dirty secret to this, which is that education effect that I mentioned. So just as education really pulls down GDP in 2020, as education normalizes with schools reopening in 2021, the flip side of that is that it really amplifies growth. And that actually accounts for around 2%. It adds about 2 percentage points to the estimated growth for 2021. So I do need to show you the projections excluding education would have last year's GDP at obviously a big slowdown, but avoiding an outright contraction, 1.3%, and then growth this year of about 5%. So I'm afraid it's not quite as eye-catching as the kind of headline number, but I would put it in context. Annual growth of 5% in this environment, and given everything that the economy has kind of been through over the last year, I would still say is a pretty robust performance. I want to make the point that when we talk about headline growth, that sort of smooths over a huge amount of differences and obviously complexities in the economy. So we think this is likely to be a pretty, you could say, uneven recovery, and there are going to be big differences across different sectors. One of the obvious ones, of course, is tourism related. So this is just the picture of international visitor arrivals. They go to zero, they open up again in August, but it's been a slow recovery. So I think the expectations are that tourism will be in this kind of slow recovery, and conditions in that sector as a result will feel very different to how they do in some of the other basically less affected and faster growing ones. I'm aware of time, so I'll keep this brisk, but near-term risks that we see to the kind of picture I just laid out. I know this can seem like the typical thing an economist is going to say to sort of cover themselves, but it really is the case at the moment that what we call forecast risk is extremely elevated, right? That expectation of growth, whether it's 6.9 or 5 without education, is a point estimate within quite a wide band. And one of the reasons for that is basically technical. It may be that the statistics agency, when it reconciles the kinds of data it's looking at and basically production side data so far, decides that actually that education impact so far has been exaggerated, and it reduces it in order to reconcile it with other sources of data. That will result in big changes in the numbers, and that's just a kind of technical risk to our forecasts that is worth flagging, because it's unusual for the technical factors to be that pronounced. The key external risks are the obvious ones. How's the global pandemic going to pan out? What's the timing and level of policy support going to be? The package in the US, for example, also what Europe is doing. The key domestic risks, same thing. How are things going to pan out with the pandemic? But our projections are also assuming that we continue to have basically supportive weather conditions for agriculture. And if that disappoints, or if this locust situation gets worse, that's a source of downside risk for us. Those are the near-term risks. And I just wanted to flag that there's also an important kind of long-term concern and frankly, uncertainty. And that's what's sometimes referred to as scarring. So this is a picture at the global level of what the bank's view is of potential or sustainable growth for developing economies like Kenya. And you can see that already there was a concern that potential growth was going to be declining from about 5% for your average developing country in this last decade to 4% for the decade to come. Now, post-COVID, that's being marked down even further to 3.4%. Potential growth. That means you can't really grow faster than that on a sustained basis without running into stability problems and kind of overheating. Why the decline? Well, it has to do with a big crisis like this having a big impact on levels of investment. Millions of kids, billions of kids have stayed at home for the past year or so. That has an impact on their future level of skills acquisition and the skills mix in the economy. Disruption to firms, right? Where firms go out of business and as a result, some of their knowledge is lost permanently. This can have a big impact. So these sorts of things are referred to as scarring. And internationally, there's a lot of concern about this. That is basically why such huge amounts of money are being spent in the advanced economies to reduce the impact of the crisis. And there's a very high degree of uncertainty, for an economy like Kenya. What's the long-term scarring going to be from this crisis? So it's something we need to keep an eye on. It's why we look at the micro data so carefully, and we're just going to have to keep tracking it. And frankly, it's kind of an unprecedented situation to be monitoring. So this is a key uncertainty. I'm basically out of time. On policies and priorities, let me just say, obviously, one of the hot topics is debt. Now, the crisis hasn't done any favors for debt, both globally. So this is the global chart of government debt as a share of GDP. And you can see the global financial crisis caused this big pickup. In some cases, debt continued to rise in the last decade, and then this last leg up is COVID having its impact. So this is a global phenomenon. It's important not only to look at the kind of debt level, but also what is the affordability of debt. And this is what, I think for Kenya deserves to be in focus. A good measure of the kind of cost of debt is what are you paying in terms of your interest payments as a share of what government is taking in revenue. And in Kenya, this has been trending, sort of steadily higher and is now at over a quarter. If we look at the budgeted numbers for this year. So, you're spending a quarter of all your revenues paying interest on the accumulation of debt. And that is obviously going to squeeze your available fiscal space for, more productive kinds of spending. And this would be the reason to really look for a reversal. A related reason is that we think, classically, when we talk about the need for government to embark on a fiscal consolidation and reduce its funding requirements, that tends to be associated with sort of austerity stories. We actually don't think for Kenya that government embarking on a really determined kind of fiscal consolidation effort would imply austerity. We think it could be growth enhancing, and an important reason for that is that as government's financing requirements have increased. And I'm showing this in the domestic market by looking at bank claims on government as a share of domestic debt. You can see that that's, as you'd expect, been steadily increasing. It's at quite high levels relative to where it's been historically. This chart goes all the way back to the 90s, and we're at over 30% now. And private sector credit growth, conversely, which can help fuel investment and private activity, is pretty slow, especially in real terms. So as government's financing needs domestically, can hopefully begin to come down, that can really open up space for more private sector lending and support to kind of private sector led growth and recovery. So fiscal consolidation in Kenya's case, is going to be good for kind of confidence. It's going to be good to open up more opportunities to redirect spending away from interest payments and towards better kinds of government spending, but it's also going to open up space for the private sector. So this is why it's so important. And then we have a whole agenda around, what the potential low-hanging fruits are for government to achieve that. Kenya, unfortunately, is not able to spend on the kind of scale that we're seeing internationally, where basically the OECD type economies can really put their foot on the gas to try and recover. So that makes it all the more important, if you don't have a lot of resources to spend, to try and support the recovery by strengthening the policy framework, right? By maintaining a focus on the reform agenda. So we can get into some of those specifics, perhaps, if that would be of interest in the Q&A. So I realize that was a lot of material. Thanks for your patience, but I hope that gives you at least the lay of the land of how we at the World Bank see it. And thanks very much. Look forward to the discussion.
Thank you. That is great, Alex. Very, very illuminating, and some really powerful data that you've presented this morning. So I'll hand over to Jared to have a discussion around what you've presented and to also share his views. Jared, over to you.
Yeah, thank you very much, Maxwell. And let me also take this opportunity to appreciate the invitation to be part of this conversation. Really interesting conversation to have, especially in this part of the year when people are trying to project on what's likely to happen as the year unfolds. Let me also express my gratitude to Alex for a very compelling presentation, very carefully assembled data that tells a story about how things are likely to evolve going forward. I think I share quite a number of perspectives with what Alex has presented, in the sense that obviously 2021 is likely to be different from 2020 in a positive way. meaning therefore that just like 2020 was different from 2019, from the pandemic that dampened economic trajectory growth, I think we're already starting to see a sense of optimism in the economy, where enterprises and households are really looking at a better year. Even though we are at the back of the queue insofar as the vaccine is concerned from a delivery standpoint, I think that also gives us that momentum that we're probably going to see the pandemic being addressed. So that gives us a sense of optimism. The projection that Alex has given is really fantastic. If only it could be realized. And I think I need to emphasize that. I mean, if we were to grow at 6.9%, all of us would be happy. But the question that one would ask is that how realizable is that growth? And it will take a stepping back and looking at where we come from for you to appreciate that that would be fantastic, but maybe difficult to realize in the circumstances that I'm going to illustrate. If you step back in the decade up to 2019, the average growth of this economy was around 5.7%, which in many respects is considered to be robust. And on the back of that was substantial investment in public infrastructure. We had, of course, a few policy missteps here, but generally we didn't have major upsets like the pandemic. And over that period, in instances where we've had a substantial slowdown, and we've had slowdowns in the past, it will take up to 3 years for you to be fully back to where you were prior to the period in which you expected a slowdown. And we are talking about slowdowns that are not as substantial as the pandemic. Remember, we had almost a lost decade in the early 1990s, and then we had problems in early 2000, and then we had our 2008, and then all those episodes majorly entailed a substantial slowdown. At no point did we recover quickly. So this would be a fast one. We have had a major pandemic, and then that pandemic has led into a substantial reduction in growth, which growth therefore has led into anticipation of a slow and gradual recovery. What the picture that Alex painted seemed to indicate that what we've experienced is a slight dislocation, yes, but there's not been any change in the fundamentals. Essentially, the engine is solid. It's just a matter of adjusting back to where we were, and that's why I'm saying that if it's realizable, it will basically be a nice story to tell in terms of how you quickly can recover from such a major shock. Which brings me to a more delicate argument to make, and I think Alex alluded to it in his presentation. What if we didn't have a pandemic? How will the economy have evolved going forward? What you can call a counterfactual argument. And to have that argument, you really have to look at what were the initial conditions that the economy was experiencing prior to this pandemic. And I could point out 3 areas where you can start forming your basis for having an outlook for this recovery that is anticipated. What is that we're really at a very weak fiscal position even before the pandemic, and that's why all the discussions around fiscal consolidation started happening. So we are talking about a situation where discussions about debt sustainability were not only entertained, but I think they were legitimately discussions that we needed to have. The second is that the financial system, especially the banking system, while stable and well capitalized, have started seeing challenges as far as the quality of assets are concerned. So we started seeing a situation where the level of non-performing loans are gradually increasing. And that is a pointer to the extent to which the rest of the business community is performing. And this we are talking about before the pandemic. And then, of course, there's the issues around the external balances, where even though it was mild by historical standards, there was still a debate as to whether we were in a good position so far as our external balance is concerned. So what you're talking about here is a situation where all the combination of those could actually be a pointer to the fact that we might have understated the extent to which the COVID has actually adversely affected our economy. And therefore, what really one needs to look is a situation to how these initial conditions are going to be a pointer to how the economy is likely to recover going forward. And here you see a sense of what you can call policy dilemmas that we have to consider as we go forward. And I think Alex alluded to one of them. We are talking about the need for having fiscal consolidation. When you have a big economic slowdown, and this is what any economist will tell you, if you have the capacity, your fiscal policy has of necessity to be counter-cyclical, meaning that you have to start supporting the economy from a fiscal standpoint. But as it is right now, I don't think that there's for us to be doing that, even if it would be the right thing to do. Because if you start going counter-cyclical, then it simply means that you're going to dig deeper in your debt situation. And that therefore means that we are caught between the need to support the economy from a fiscal standpoint, while at the same time the need to have a fiscal consolidation that is necessary given the kind of situation that we have from a debt standpoint. But that's just one dilemma. The other dilemma is really on the monetary side, and this is something that many people should talk about. Obviously, the monetary policy has been very accommodative, especially in the period post the pandemic, which is a good thing. But to what extent has that monetary policy being accommodative supported the flow of resources to enterprises? It's one thing for policy to be accommodative. It's quite another for that policy to lead into resources moving into enterprises, especially on the back of very weak demand. If the picture I painted as an initial condition of non-performing loans within the banking system being high, what we are seeing now is slightly worse than that. I mean, we're talking about the levels of 12% now moving up to 14%. And on the back of that, the financial system has been grappling with how to manage the existing loan book. So we've seen substantial restructuring of loans by the banking system over the period. Actually, the estimates from the central bank indicate that close to 55% of the total gross loans by the banking system have gone through some form of restructuring. And it's not very clear whether that restructuring has really led those enterprises really picking up. What that simply means is therefore that all the bankers will basically be wearing a belt and a suspender at the same time, meaning they'll be taking extra caution in terms of how much they'll be giving out as credit. And that's why one of the charts that was really compelling that Alex presented is a situation where you're seeing the credit, the private sector not being responsive. You can imagine increasing non-performing loans. You can imagine a situation where now there's a public need for resources and therefore a pointer to crowding out effect. Now, that simply tells you, therefore, that there's a dilemma from that. But that's just one dimension of the dilemma. The other dilemma is a situation where now, because of the picture that I painted on the external position, we are seeing a correction in the currency side, the shilling kind of weakening. And that therefore puts the policy in a tight place, because on the one hand, you're accommodative, on the other hand, we have a weakening currency. And the choice will be easier because there's no room for monetary policy to be tighter right now in the current circumstances, meaning therefore that now you can start seeing probably a further gradual adjustment on the currency side. That has its own implications insofar as our external debt policy is concerned, and also insofar as it may actually have implications of filtering into inflation, which right now is a bit contained. And then now look at all that in totality with what you can call the read of the leading indicators. Of course, hotel occupancy is pretty low, and that tells you therefore how that filters into the wider tourism industry. I've already alluded to the weak credit, and the weak credit numbers actually mask a lot of things. First of all, they mask the fact that now we have a substantial portion of the MSMEs that are not getting credit, and really they're a big driver of growth. There's limited scope for additional investments, meaning therefore that businesses are grappling to utilize the existing capacity as opposed to adding more capacity in the circumstances. Of course, agriculture, if the weather is favorable, will really be a turning point. We are seeing a gradual recovery in growth in trade, and trade is a major consumer of financial resources and actually a big component of the economy. So some of these leading indicators actually point to a very gradual recovery at best. And that's why it will be nice to see whether that the projections of between 5 to 6.9 will actually be realized. And then this therefore leads to what will be really what you can call the key policy drivers, especially from a reform standpoint, that will support this recovery so that it entrenches itself going forward. We are looking at debt restructuring, and that's a point that Alex has made. But you also have to start looking at what kind of policy measures we need to put in place to support the productivity of the economy. And productivity will actually lead into enhanced competitiveness. You can imagine a situation where the trade to the rest of the region is subdued just because of COVID, but also because gradually we've been losing competitiveness relative to other trade partners for the region. But also there's a need to streamline and enhance capacity of the devolved government, because much as we've been having an expansionary fiscal policy, there's a view that the devolved system has not really addressed the issue of wastage of public resources, which could actually be a good initiative to ensure that the devolved government could also be an engine for supporting growth at county level. So all that, and throw in the fact that now we are more or less a noisy political environment, will inform the extent to which the economy start gradually peaking from the slowdown, even though the shrinking that was expected, to be realized because of the pandemic. So I've seen forecasts. The lowest I've seen is by the Economist Intelligence Unit, which talk about 2%. The IMF, which is typically very optimistic, is giving a rate of growth of about 4.9%. So I realistically see much lower growth than the 6.9 that Alex has talked about. Of course, taking on board the number of the downside risks that he alluded to in his presentation. So really, that is how I see this picture playing out. So whereas I fully share the fact that this will be a slightly better year than last year, by no means, I don't see a quick rebound to that rate of growth. And therefore, that is really my nuanced view to an otherwise very eloquent and carefully assembled presentation that Alex has given. So that's really what I would say, and invite Alex to see whether the areas where we can have a common ground insofar some of those things that I have slightly divergent views are concerned. And I thank you very much. Back to you, Alex.
Thank you very much for that, and injecting some, would I say, a dose of reality, and just giving us a slightly different perspective. Alex, why don't I allow you to make a few comments? Give your perspectives on what Jared has just talked about.
Absolutely. Absolutely, I'll keep it brief, but Jared, no, thanks very much for those thoughtful reactions to the views that we expressed, and I think actually there's a strong complementarity in terms of we see these sources of continued potential positive trends. We've wanted to give those their due in the outlook. There are these technical factors that I think amplify the kind of headline factor when you look at a big number like 6% plus 6.9 in our case, where we have these unusual things, right? Like the technical effect of a normalization in education. But I take the point that you would see even 5% for GDP excluding education as potentially somewhat optimistic. So if we think about rather the kind of band of possibilities, the forecast range rather than a point estimate, I suspect that the reality is we have a wide band around the point estimate that I presented that I think would probably be able to encompass even your point estimates, Jared. And in terms of complementarity, I'm in a lot of agreement with you've placed emphasis on what some of the big challenges and potential drags on the recovery are going to be, and really all of those points are well taken. I would say on the weak fiscal position as you described it, Yeah, I mean, this is a good example of how it really is important to keep as much focus as possible on maintaining your, what's sometimes called the fiscal buffer, so that when inevitably a crisis, whether it's the pandemic or whatever, does hit, you've got the kind of space and the leeway to respond. And Kenya wasn't alone in this, but unfortunately, that was not the case coming into COVID. You had already, a stretched public financial situation, and then that's only been amplified. So I think that really just, puts even more focus on this agenda. And there are things, and you alluded to them as well, Jared, that governments I think can do that would not be a case of really in a potentially damaging way to the recovery, cutting spending left, right, and center. But there are opportunities, to basically spend better, right, to reduce waste, whether it's wasteful spending, whether it's at the county level or elsewhere. Government has a big public investments portfolio. Many of those projects are not performing well in terms of project implementation. Are there opportunities, and the minister spoke to this quite recently, to relook at that public investment portfolio, to prioritize what are our big high impact projects. If some of them are experiencing blockages, let's tackle those. Let's deprioritize or even look at streamlining out of the portfolio the underperforming projects. Basically, in a crisis and a crisis response situation, I think it really puts the focus on trying to prioritize what can we do that can really have an impact. And I think there are some near-term opportunities that could really help in that regard. But no, thanks again for the very interesting not rebuttal, but complimentary comments, which we'll also take on board. It's helpful for our thinking because we'll soon be going into our next forecast round as well. Back to you, Maxwell.
Thank you. Jared, you look like you want to make a quick comment. We are running out of time, unfortunately. I'd like to bring in the audience. So if you want to make a quick comment.
Yeah. No, I think I'll leave that comment for the audience. I just wanted to mention that we have this long debate around remittances, and I think remittances are good. But as an economy, you have to start thinking very carefully when you start seeing remittances shooting way ahead of your export earnings. It speaks to the extent to which your economy, domestic economy, is driven by your exports as a support for balance of payment, as opposed to relying on remittances, important as they remain. So that's the point I wanted to make. And that speaks to the wider situation of, when you talk about the closure of the current account, the asymmetric effect of, when you're closing your current account because you're importing less, having a fundamental different effect on the economy as opposed to when you're closing your current account because you're exporting more. And I think it's something to think about as we reflect about it. But let's allow the audience to come in and we have an engagement.
All right, thank you. Thank you, Jared, for that. So there's a couple of questions that have come in through the Q&A. I can also see some in the chat. I'll do my best to make sure that we cover as many as possible. Unfortunately, I know we've run out of time, so I'm going to beg for at least another 5-10 minutes to see how much of the questions we can address for the audience. Benson Okundi is asking, the exports 20%, in 2020, the increase in export by 1.8% compared to 2019 seems to be quite a surprise to many. What drove this? What would you say to that, Alex?
Yeah, no, I'm equally pleasantly surprised. There's lots of differences between the different export categories. So some categories clearly, did come under a lot of pressure, and we need to bear that in mind as we just look at the aggregate. But the real drivers were tea had a very good year. That's obviously an important category. And I think, not to make light of it, but as a result of COVID and people being at home, I think tea consumption increased quite a lot, and that was certainly helpful on the price side, if not volume. So tea did well. Other categories of horticulture, and then even even if you look at cut flowers, they took a big dive. but then they rebounded very well. I think that was helped by, some of the adaptation. Kenya Airways, converted capacity from passenger to cargo, for example, and they were able to keep going with the transport into Europe. And then going into the end of the year, unfortunately, of course, the COVID re-intensified in Europe. And so I think the end of the year again was not that great. But overall, if you look at the year as a whole, flowers actually also did better than you might have expected. Yeah, but look, let's not get carried away, in the sense that I think it is very encouraging, and it would not have been intuitive that your value of exports actually increased in a year like 2020. But it's not a big increase. And if we look at the overall structural trend, there's a real need for Kenya to look at these international competitiveness issues that Jared mentioned, and to get that export growth back up, because that has a major impact on the resilience of your economy, funding your balance of payments, even your debt risk indicators. Many times it's exports that are on the denominator. If you can bring your exports up, your debt risks decrease because you've got more dollars, to pay the debt. It deserves to be a major priority. And there are obviously a variety of factors that have been holding back, what exports can be doing relative to their potential. Maybe Jared, you'd want to come in on this as well?
Yes, just a quick comment and to add on what you just said. The one thing to appreciate is that we saw drastic in oil in the period prior to the COVID pandemic, but we've started seeing a gradual reversal of that trend. What you need to appreciate that no commodity prices track each other. So when you see oil prices turning the corner, the other commodities are turning the corner. So there's a very strong likelihood that the value of exports increased on account of the gradual turning of the commodity price cycle. And that turning substantially compensated for, more than compensated for what we export to the region, because we don't export the same commodities to the region. So I think that's a factor that you need to consider to what Alex has illustrated.
All right. Okay. Thank you. Joyce-Fan, you could go ahead and ask your question directly to the panelists. Just unmute yourself and ask your question. Joyce-Fan? Well, if she's not ready, I can ask a question for her. I think one of the biggest anticipated challenges that we are seeing is really this issue of the politics of our country. The BBI, the political campaigns that are picking up, then the elections coming up in August of 2022. How is this bound to impact the economy, and especially in the context of the economic recovery that we're talking about? So that's for both of you. Feel free to give you.
Thank you, Joyce-Fan, for that question. And I think I hinted to the fact that now we sometimes have a very noisy political environment, and that tends to reveal itself to how investors perceive our economies as an investment destination. We've already started seeing political noise increasing by the day, but the fact is that our politics has always been noisy all through. You start seeing a campaign immediately after the elections, and so the investors actually most probably are factored in the fact that that is our nature to campaign almost perpetually. So what I'll say here is that whereas it may actually have an influence on what you can call portfolio investment flows, it may not have a huge impact insofar as negatively or adversely affecting what you can call the normal foreign direct investment that could come in pursuit of the market fundamentals. One thing that is comforting is that at least now we have a predictable political calendar where we know that we have elections from time to time, noisy as they may be. And I think if recent global experience is anything to go by, it simply tells us that it's not just our politics is noisy, it's noisy everywhere, even in those countries that we consider to be model. You know what I'm talking about. So yes, politics will affect investments, and it may have a dent insofar as expectations of stability is concerned, but not to an extent of upsetting economic performance. But it has to be seen in totality of other likely downside risks, not necessarily as a standalone contributor to any expected economic outcome.
Okay, all right. Alex, your view, briefly?
Nothing too pointed to add to that answer. It's normal that there's a kind of political or election cycle that affects the economy. That's obviously been intensive in Kenya in the past, but it does seem like there's been progress made, to sort of manage that inevitable volatility. But as we look ahead to 2022. I mean, yes, it's the case that as the political noise increases, it's going to be more difficult to maintain progress on what you might call the kind of medium-term reform agenda, to do things that do generate political attention. And so I think that, again, that only increases the urgency of acting in the current window, to continue to make progress on doing some of these things that can support basically the productivity of the economy and give investors that confidence, so that yes, they then are able to look through sort of near-term noisiness, but have as much confidence as possible in the kind of the real longer-term path of the economy, right? So back to this reform agenda, that where there may not be easy money to spend, to help address the crisis, there are policy changes and improvements and reforms that deserve to be the focus.
Okay. Is there, or has the Kenya government issued its own projection for GDP growth this year? And perhaps you can address that with David Funival's question, who's asking what impact has government spending had on growth overall? Alex, you want to comment on that?
Yeah, I think government's numbers are actually in the similar ballpark to ours. I was just trying to quickly look them up to make sure I didn't give the wrong point estimate. Yeah, government sees 6.4% in 2021. So they're also looking, for a pretty pronounced rebound. I think, the role of government spending, certainly it's a source of support, right, to aggregate demand. But I think, to Jared's point, it's not the case now that it would be helpful to, seek to increase that level of public spending in order to support the economy, because we are at the point where that's coming along with debt costs that, are also quite significant. So I wouldn't say that we're in a situation where wanting government expenditures to do more to continue to drive growth is really where we're at. I think it's going to be more productive to first credibly signal that that commitment to fiscal consolidation is still there, and then as the economy strengthens enough to make implementing that feasible, you do that to open up space more on the private side.
Mm-hmm. All right. Two final questions before we close. AFCFTA coming online. Any impact that you project in terms of our own economy?
Thank you. Yeah, I think that's a really interesting question. So the bank sees potentially quite major gains for growth and for incomes from doing this. So it's a really positive and I think exciting kind of development recently. But I think it also calls for realism because we're talking about a current situation where a lot of Africa's transport infrastructure is oriented towards, frankly, the extractives, right? Taking out commodities and exporting them to other continents. So there's an enormous amount of work to be done, both in terms of actually getting the harmonization of regulations and policies to facilitate this trade between countries for the first time, but also the physical infrastructure, right, that needs to be in place to make it easier for goods to flow across the continent. So I don't think it's going to be an overnight thing where we see it really making a difference in the numbers. But as a kind of development pathway and the direction that could be a really good one for the continent to go in, we do think this is a major development. And Kenya is really well placed already, obviously, as a regional hub to play a big role there. So I'm glad that question came up. I fully agree. I think it's an exciting one, even if we don't see it overnight.
Yeah, maybe I can also add a comment on that, because I think it obviously a good development, but it should be seen as the beginning of a journey. Because beyond fiscal infrastructure and all this reduction in tariffs and all that, there's a lot that needs to happen, including what is it that you're producing that you're going to be able to trade across borders. Because it's one thing for you to open up the market, but it's quite another for you to see what you produce competitively that you can be able to trade across borders. That's one. The other is really to look at whether the financial infrastructure itself can be able to support trade across the borders. Because if you have to trade, there has to be finance that is really supporting that, underlying that trade, as the second thing that you have to take into account. And finally, there has to be a lot of harmonization of policies themselves, because different governments in Africa or different economies have different policy setups. So some of which entail, cross-border payments and stuff like that may actually frustrate intra-African trade. So it's a good thing. It's beginning, but I think you have to start building on it so that it can be an engine for growth in Africa.
Excellent. So finally, a question from me. I think we've managed to cover or touched on most of the questions that came in from the audience. There's this, so we talk about 6.9, 5.0, 5 point whatever GDP growth. However, like they say, and I'm sure, Alex, you probably had this expression by now in the 1 year you've been here, qua ground, things are different, meaning on the ground, ordinary folk don't seem to feel the impact of this impressive GDP growth that, we keep touting, we keep talking about. What will it take for that growth to really translate to the common wananchi, the common folk on the ground, for them to feel the impact of this, excellent economic performance that we've been talking about over a period of time, and hopefully the recovery that we're looking at this year and in the coming years? Both of you, actually, I'd like your comments on that.
Let me start, and then Alex, he has also been on the ground, so he can explain this. For me, it's really simple. If you match output with expenditure, then you'll have addressed things qua ground. A maize producer in Kitale, once he produces his tons of maize, it counts as GDP, and you can report very impressive numbers. But if that maize farmer has not really sold the maize to the market and is able to spend, then qua ground things are completely bad, even if the numbers are really looking good. So to me, it's really matching output with the ability to spend. And that's really where now there's a problem or a huge disconnect, because we measure things in a way that does not really reconcile those two aspects. So that's really my simple illustration of why sometimes you can have a very good output growth, which measures as GDP, but you're not able to spend, and therefore you don't feel that growth. As one commentator put it, you can't eat GDP. So that's really how I look at it. Maybe Alex has a different view.
Thanks, Jared.
Yeah, no, I do agree with that, and I think it also has to do with disconnects or issues, if you like, in the economy where we have a very predominant informal sector, right? And in many ways, the agenda around supporting all the sole entrepreneurs, the small businesses, people who are working in that large informal sector to get connected to more opportunities, right? And have that sense of having a stake in the economy in a more certain way can make a difference. And that's obviously hard to achieve given the kind of scale of the issue. But I think that's something that over time can start to build that sense that a GDP result is not just a kind of abstract number that economists talk about it, but you can sort of feel it and see it in terms of whether it's a more effective delivery of government services, improvements in the quality of infrastructure that you're using that can also help your business, specific things that governments can do. Maybe it's supporting easier access to credit, right? Giving people information about what more market opportunities there might be. But I think the sense that there's a potential disconnect in those headline economic performance numbers and what people are really feeling qua ground. It's an important note to end on, because I'm not sure that we as economists actually have great answers on this. So it's something to also explore as part of the analytical agenda that we have to understand the economy better. Like Kenya is making progress in the kinds of poverty statistics that we track at the bank. There's significant ongoing progress to reduce what we would call extreme poverty, real life-threatening deprivation. But that doesn't mean there isn't also real challenges where, on average, Kenyans may be doing better, but there's still vulnerability to getting knocked back. And then, a shock like COVID happens, and that's obviously, we saw it in some of those survey results that I showed. That then has a massive impact, and it doesn't exactly make people feel secure about their situation. So I'm glad you raised that point, Maxwell, and maybe next time I'll try and have a better answer for you on GDP versus qua ground.
Thank you. I know we are 20 minutes over time, but there's one more question I think it would be really remiss of me not to ask. Are there, as economists, just I would like your view, are there viable income generation alternatives for government other than just, taxing us to oblivion? Are there any viable alternatives to that?
You want a straight first economist answer? I mean, government funds its expenditure using tax. And the underlying assumption is that the government is benevolent enough to create an environment where enterprise and households are able to earn income, which is then taxed for it to be able to provide what we call public goods. So unless you want us to go back to those days where government used to own enterprises that then used to give profit, and then that profit is going to fund some of the programs, the government's recourse is essentially tax. And where its expenditure programs substantially exceed the tax revenue, then you see it coming and borrowing. So those are really the two avenues it has. And if there's an imbalance between to what extent is able to tax and how much is borrowing, on the one hand, you have the risk of taxing to an extent, you become uncompetitive as an economy and you disable even enterprise. On the other hand, you may actually borrow to an extent of actually burdening the future generations, either business or households. So when you hear people talk about fiscal policy that is really sustainable, is one that has a very careful balance between how you can tax and how you can borrow, with the view to meeting your expenditure programs, which expenditure programs are assumed to be supporting enhancement of the capacity of the economy. So that's really, unfortunately, where the government has an avenue to get resources for expenditure. There's no any other source.
Okay, all right.
Yeah.
All right. Alex, you want to comment on that as well?
Yeah, I'm afraid the bad news, Maxwell, is Kenya is not a particularly overly taxed economy if you look at it on the sort of aggregate levels. And in fact, I think KRA has had a hard time in some ways keeping up with a changing economy, right? So if you look at the revenues that government is getting as a share of this famous GDP that we've been talking about so much this morning, that has been slipping. And part of the reason for that is that, as economic activity goes to new places, the taxman has to catch up to get his share of that. So it's a bit of a moving target. And just as Jared says, it's about finding the right balance between mobilizing enough tax and then making sure that expenditure is spent as productively as possible, so that you're in a kind of a virtuous circle in the economy, not sucking activity away that then doesn't go back in and have as much of a positive effect as possible. But again, here, Kenya is far from alone. We look at it in many of the countries we work on, and there's a very strong focus on debt, which in some cases, of course, is appropriate. But debt is like a residual, right? So in many cases, that is a product of some of these difficulties around finding that balance and getting tax to play its right role. So I'm sorry if we haven't given you the answer you were hoping for, but that's how we economists see it.
All right. We have to bring this to an end. Gentlemen, thank you so much for your time. Thank you for your wisdom. Thank you for your insights. And thank you for edifying us this morning. Special thanks to all who took time to attend this forum this morning. We are almost half an hour past our time, and we still have 58 participants on the call. So this points to the importance of this forum. So I just want to again say thank you and to wish everybody a fantastic day. We've come to the end of our forum this morning. Thank you.
Thank you.
Bye.
Thank you. Bye.
Bye. Thank you.